Welcome back everyone. I hope everyone's doing good. In today's lesson, we're going to be focused on liquidity. Specifically, we're going to be talking about buy side liquidity and sell side liquidity. So we're going to be focused on old highs, old lows, and equal highs and equal lows. So the first thing we're going to talk about are swing points in the market. So a swing point is basically an old high and an old low, and how that is and how you find those in the market are as followed. So we have a swing low here, and how that is formed is when a candle on the left hand side forms a higher low, the middle candle forms the low, and then the right candle forms a higher low. So you got this low needs to be higher than the middle low, the middle candle's low, and then the following candle's low has to be higher than the previous candle's low, which forms a low, and that's vice versa here. Got the candle on the left hand side forms a lower high, the middle candle forms a high, and then the following candle on the right forms a lower high, which is lower than this high, which forms the higher swing point. Now, to understand why these swing points are so important, we need to understand the psychology of a trader. If someone was supposed to go long here, they're most likely going to put their stop losses below this old low to protect their positions from getting stopped out. And on the flip side, if they wanted to go lower and add a sell position to take the market lower, they'll put their stop losses above old highs. So when their stop losses below this old low, this is called a sell stop. And when their stop loss is above an old high, that is called a buy stop. With sell stops resting below here and buy stops resting above here, this is called sell side liquidity, and then this is called buy side liquidity. And what smart money or the market algorithms tend to do is they like to pair orders below these old lows and pair orders above these old highs. Moving on to the charts now, I'm going to show you what buy side and sell side liquidity highs and lows look like in an actual charting environment and charting scenario. So here on the left hand side of the charts, we have, let me zoom in. So we got sell side liquidity at this low and this low. The reason is, so we have this candle on the left hand side, its low is higher than this candle's low, and the candle on the right hand side's low is higher than this low as well. So we have a swing low, same as here. This candle's low is higher than this candle's low, and then the right hand side's candle's low is higher than this low as well. So we've put in another low. So the sell side liquidity or sell stops below these two lows. So if we print to the downside, we've now taken out these two lows. As you can see, if we keep printing, we've put in, oh no, I'm not going to count that, it's not obvious, I'm only going to look for the obvious ones. Buy side liquidity buy side liquidity was formed here. So on the buy side, we have this candle's high is lower than this candle's high, and on the right hand side, this candle's high is lower than this candle's high. So we've put in a high where buy side liquidity is, or buy stops are. Prices ran into that. So yeah, we've got this huge move to the upside. We've taken out this previous high, buy side liquidity above that previous high. We've got another swing high here where buy side liquidity resides, or buy stops reside. So price could reach into that and look to take that out as well. With this huge move to the upside, we have sell side liquidity that's printed down there. So let me just clear up the chart a bit. So yeah, price right now is in close proximity to here, so it's most likely gonna move up into there. So with this huge candle, we took out buy side liquidity and sell side liquidity as well. So yeah, so with price moving to the downside here, traders looking to go short would place their stop losses above this old high and possibly above this old high. Price then moves higher to take out those highs. So there's buy stops residing above here and buy stops residing above here. Price has gone up to take out those buy stop levels. Price then moved lower again to clear these sell stops or sell side liquidity below here. So price has moved higher. Traders looking to enter the market with buy positions would put their stop losses below here. So sell stops will reside below here. Price has come back down to take out that area, and so take out all the orders below this area here. And what smart money and the market algorithms, like I said in the first clip, like to do is they like to pair orders below this low. So they take out sell stops. So they sweep sell stops and pair it with buy orders to look to take the market higher. And then, as you can see here, we take out. So there was another buy side liquidity. There was another swing high where buy side liquidity resides. It's formed here. So we've got this candle's high is lower than this candle's high, and then this candle's high is lower than this candle's high, which has formed a swing high where prices come down into here. Smart money have paired orders with the sell stops, and they paired it with buy orders to then take the market higher to take out the swing high where buy side liquidity or buy stops reside. Next, I'm going to talk about two different types of liquidity. The first one is old highs and old lows, and the second one is going to be equal highs and equal lows. So for the first one, the old highs and old lows, here we got an old low, we've got another old low, and then that forms an equal low. So this low is relatively close to this low, so that makes it equal, which price tends to deviate towards a lot of the time. Like here, price deviated toward that with speed as well to take out those equal lows. We've got highs here, we've got a high here and a high here. This high is relatively close to this high, which price deviated to. It took it out with a huge wick, then it moved lower. We've got another equal highs here. So we've got another high here, then another high here. It forms an equal high, and in the future, price could move towards there to take up those equal highs as well. We've got another set of equal highs here as well. So we've got an old high, and then we'll look for price to possibly, or price did take those levels out with speed as well. As you can see here, this huge bullish candle took out these two equal highs. And another set of equal highs we tend to look for in the market are just huge clusters of equal highs in the market. So something looking like this, it's not exactly two highs to make an equal high, but it's a cluster. So the wicks, they're very close together. So it doesn't look like this wick and then a long wick. The wicks are relatively close together. So price could look to deviate towards that as well. Let's look for one more example of a cluster. Here we've got a cluster of lows here. So if I circle it for you, get a circle. So yeah, we've just got a huge cluster over here. Price moves down with speed, takes it out, it moves higher again. Then we've got an equal low here. We've got an equal low. We've got another equal low. I'm sorry, my mind is in the gutter. I just pictured something, but yeah, we got one low here, another low here. Price took that out with speed, so those are equal lows, and then price moves to the upside. We've got equal highs, and price looks to deviate. Then we've got an equal high here, and then another equal high. So we've got two equal highs here. Price takes that out with speed as well. So that's that on equal highs. What I'm going to talk about next are important levels of liquidity in the markets. So there are three types of important levels I look at. That's the previous week's high and low, the previous day's highs and lows, and the previous session's high and lows. So for the first example, I'm going to show you previous week's high and low. So if we start from Monday, let me get this up. If we start from Monday, the 24th of March, so the previous week starts from the 17th of March till the 21st of March. So here's the lowest point of that week, which is the Friday low, which I've marked out as sell-side liquidity. And the highest point of the week was Tuesday's high, which I've marked up as buy-side liquidity. So I'm looking at these areas as reversal points. So if the market, so right now I'm looking at the market is pushing up higher, so I'm looking for buy positions. So what I would want to see is price to sweep the previous week's low, so the sell side liquidity below here, and like the previous clip, if I'm looking for a swing low to be taken, I would like the market to pair that sell side liquidity sweep with buy orders to then look to take the market higher. So we get a print. Oh gosh, market's not printing. What's going on? As you can see here, so we have Friday's low, next candle's Monday, we get a little sweep of Friday's low. Then the next day, Tuesday, we've got to dig deeper. Then on Wednesday, price dug into the daily fair value gap. Then on Thursday, we got the sweep of Wednesday's low, and then we closed higher. And then price began to move higher and move higher to then target Tuesday's high of that week we were looking at, and then price traded straight through it. So I'm going to repeat it again. So we got the move to the downside. So price swept that previous week's low, so that Friday's low. Then the market started to pair the orders. So we've got a sell side liquidity sweep, and it's getting paired with buy orders. And then price began to move over to the upside to take out buy side liquidity or buy stops. And then we've got a punch through that liquidity level above Tuesday's highs. So the first important level of liquidity was the previous week's high and low, and the next was the previous day's highs and lows. And another important level of liquidity that I look at are the session's highs and lows. So throughout the day, there are certain market sessions. That's the Asian session, the London session, so London Open Kill Zone session, the New York Open Kill Zone session, and then the London Close Kill Zone sessions. So the Asia's from 8 o'clock p.m. Eastern Standard Time to midnight. Then London Open is from 2 to 5 Eastern Standard Time. Then you've got New York from 7 to 10. And then London Close is from 10 to 12 Eastern Standard Time. So to help me navigate through the day, what I tend to look for are session highs and session lows. So a quick example for you, we have Asia. So I'm going to mark out Asia's high, and then we got Asia's low. So because my bias for the day, for the Wednesday, is bearish, so I want to look for sell positions. So ultimately what I would want is for price to move higher and take out Asia's high, so smart money could pair orders to look for sell positions. So I'm taking up buy side liquidity and then waiting for smart money to pair orders so I can get in short to sell, to add sell positions. So we've got the new day now. Price prints higher. We take out the Asian sessions high. So now we'd want to see a displacement lower to the downside. So ultimately what I would want to see is that huge displacement possibly break or take out this low and then enter our sell positions here. So then take price lower and reach for the previous day's low, which was Tuesday's low, which was another important level of liquidity to take out. So that's previous day's low. So carry on printing. So price reaches Asia's low, it taps into it a bit and then it moves higher. If you carry on printing, price then moves completely higher to take out the London sessions high. So now we've taken out London sessions high, so that's another session high that we've taken out. Plus we've taken out the previous day's high as well. And then price has paired orders up here again. So we've taken out buy side liquidity, to then pair it with sell positions, and then we get our move lower in our intended direction to then take out the previous day's low. This is why I always say that it's so important to take profits as a trader and pay yourself as a trader. Because imagine you've entered a sell position here and you haven't taken profits as a trader, and then price moves against you again and takes you out of your whole position. Whereas if you've entered a sell position here and then you used Asia's low as your first target to take out profits, you would have protected yourself as prices moved higher to then take you out of the trade. So I can't reiterate it enough. Taking profits as a trader is so important. Please pay yourself as a trader, because it's not in every setup. It's not guaranteed. No matter how good this trading setup looks, it's not guaranteed. It's never guaranteed. So always pay yourself. Remember, trading is probability based. Nothing's ever guaranteed. So yeah, but obviously that's another rant for another video. So yeah, that's that for that. So yeah, those are all the liquidity levels that I tend to look for in the market in terms of buy side liquidity and sell side liquidity at old highs and old lows. So previous week's highs and lows, previous day's highs and lows, session highs and lows are where a lot of market orders are placed or based around when it comes to the market. As you can see here, the market reacts very aggressively to these levels. Yeah, I advise you to just go check it out for yourself. I'm going to do one more example of a session high and low. So here we got the USD Swiss franc, and we have Asia session high and Asia sessions low. So we're going to draw that out in time. So Asia sessions high, and then we got Asia sessions low. So right now my bias is bearish, so price is moving lower to the downside. So what I would want to see is a move above Asia sessions high, so price or so smart money can pair orders above an old high with sell positions, and then we can get a move lower to target our draws on liquidity to the downside, which for now is Asia sessions low. So if we print price, so now we have the London sessions high, so London open sessions high, can draw that out in time as well, which price is already balanced. I mean, it's already taken out London sessions buy side liquidity. Price then moves higher to take out Asian sessions high and take out the buy side liquidity, where smart money will look to pair the buy side liquidity with sell stops or with sell positions, and then we'd want to look for a displacement to the downside. To then look for sell positions to target Asian sessions lows. So if we just print that out for a huge move lower, a huge wick, and then price reaches for its intended target. But notice how we've moved higher to the upside. We're looking to pair buy side liquidity with sell positions. Price has moved, but look how when this candle opens, look how the wick, it doesn't even sweep the New York session high, because price has already done the work. It's already done the order pairing above here. Price wouldn't then want to go to the upside and take that level out. It's already done all the work, so it respects that high and then moves lower and then closes. Once the orders have been paired up here and it displaces lower, its next target or its next aim is to try and look for sell stops and target London session lows or the Asian sessions low, which was looking to target in the first place. So that was its main aim, to target this area here. There's no point of price then moving back above where orders have already been paired. It just wouldn't make sense, and it would be unhealthy for the market. So yeah, that's when we got the move lower to the downside. But yeah, that's that for today. Well, that's that for this lesson, sorry. If you found this lesson insightful and you enjoyed it, drop a like, subscribe, so you can see more of these videos. I've got a lot more in the vault to share with you guys, just to make the trading journeys a bit easier. So yeah, man, just drop a like, subscribe, and have a nice day, and I'll see you in the next video.